and a warm welcome to today's workshop on understanding credit ratings, the role of credit ratings in deepening the local debt capital market. We are excited to partner with Agusto and Co. for today's session. So last September, Agusto introduced us to credit ratings during our commercial paper workshop. And from the feedback we got, participants wanted a fuller session on credit ratings. So today we are delivering on that promise. We are dedicating a full hour to exploring more about credit ratings and how it drives the fixed income market. My name is Umar Kadir English with GIFIM, and I'll be your moderator for today's session. With me from Agusto are Wonu Kunle-Bello, Country Manager, Ayokunle Olubunmi, Head Financial Institution Ratings, Christian Obiezu, Manager Corporate and Municipal Ratings, and Prince Pacheco. I hope I didn't butcher your names. So Ayokunle will guide us through the first part of the presentation, and Wonu will follow with the rest of the presentation, and thereafter we'll have some time for Q&A. So a part of our housekeeping rules, you can submit your questions via the chat box or Q&A part of the system, and your microphones will be muted until you are allowed to speak. So thank you once again for joining us. Monu, over to you.
All right, thank you very much, Umar, and good morning, everyone. Thank you for being timely. I'll start by introducing Agusto & Co. very quickly, and then I'll hand off to my colleague. So today, we're going to be discussing the role of credit ratings in the development of the debt capital market. This is a conversation that is not a one-time conversation. It will be a continuous conversation and would intend for it to continue to be so. So this is the first of many. Today, we'll talk about what credit ratings are, the importance, the impact on economic stability, the relationship between credit ratings and the debt market. And of course, we'll look at some examples with Nigeria and Kenya, and then we'll talk about the lessons that we've learned since our foray into the Ghanaian market. Okay, so looking at Agusto & Co. Agusto & Co. as an entity has operated since 1992, so we're over 30 years old. Company is licensed by the Securities and Exchange Commission in Nigeria, being the first of its kind in 2001. In 2013, we were registered as a credit rating agency in Kenya and Rwanda. In 2022, we received our approval from the Climate Bonds Institute to be a CBI verifier for green bonds. And in 2023, we registered as a credit rating agency in Ghana. Okay. We've issued more than 3,500 ratings across the countries that we operate in till date. The offerings that we have credit ratings, research, green bond verification, and risk management. So I don't want to bore us too much with the details of who we are. And at this point, I'll just hand off to my colleague, Ayokunle Olubunmi, who is a senior manager within the group and the head of the Financial Institutions Ratings team, to take us through what credit ratings mean, and what the outcomes are likely to be using the methodologies that we have. So Ayokunle, over to you.
Okay, thank you very much, Wonu. Good morning, everybody, and welcome to the webinar. Okay, like Wonu mentioned, right, so we'll actually we'll start the discussion by talking about what credit rating is, right, and also the importance of credit rating. Okay, so I think the best way to start is to look at these quotes by the United Nations Economic Commission for Africa, rather, right? I think it gives a quick overview of what credit ratings are, right? And it says that credit ratings provide an essential measure of relative credit risk, facilitating the efficient issuance and purchase of bonds and other debt instruments For an African government and corporations, credit ratings are pivotal in determining borrowing costs, right? So credit rating is simply, right, as we can see here, is just a way of even assessing the financial strength, right, and the ability of a particular entity to meet obligation as and when due. And credit rating is very important for us, particularly for us in Africa, given the kind of challenges that we are contending to. Like we all know, unfortunately, they always say that bad news sells fast. So the lot of narratives that they put out there about African countries is very bad in terms of we're going through a lot of crises in terms of the FX crisis, the debt issues, and what have you. So you realize that for an African country or also a corporate operating in Africa, it's good for a credit rating so that you even put out your financial strength and tell your capability. But having said that, before that, let's look at what credit ratings are. What is even credit rating all about? And like I mentioned earlier, a credit rating is simply an independent assessment of a particular entity or an instrument to determine the financial strength of that entity and the ability to meet the obligation as and when they fall due. Broadly, we can say that we have two types of ratings. The first is what we call issuer or entity rating, while the other one is what we call the issue or the debt, or the issue rating, or which is focused on the debt instrument. Let's first talk about the issuer rating. For the issuer rating, we are looking at a particular entity, an institution, and we are looking at the ability to meet, on average, all its obligation, and is not specific to all the debt, right? Either existing obligation or even the one that we actually even occur during the life of that particular rating. We take that into consideration, right? We are looking at the ability, right, of that particular entity. For the debt instrument, here the focus is on a particular instrument, right? Either a commercial paper, a medium-term note, or a bond, right? Depending on that particular instrument. Here we are looking at the ability to meet obligation on that specific instrument. Although at times, oftentimes, the rating tends to mirror that of the issuer. However, if there are guarantees or if the debt is structured to be subordinated to all the other obligations of the issuer, the rating may actually differ from that of the end. Now let's talk briefly about what credit ratings are, because we've noticed over the years that some people have a wrong notion of what credit rating is and what a credit rating can actually do. I think first of all, what is very good to clarify and put it out there, that credit rating is not based on equity analysis. It's not looking at how a company will be able to add value to shareholders, and it's not giving you a purchase recommendation on the shares of a company. Although at times you see some correlation in terms of the ability of a company to give value to the shareholders and good ratings, right? You see that some companies that have good ratings, they tend to give value to shareholders, but there's no causation around them. So they are quite different. For credit rating, the focus is solely on the ability to meet obligation as and when they fall due. Another thing that we need to also be clear about is that the information that we use for credit rating are those provided by the entity. Of course, the entity will have to even give us an undertaking that those information are actually true and fair. We also have our own ways of even verifying some of those information. However, we won't go through the extent in which the auditors go through to actually ensure the veracity of those particular information. So in a way, you can say rating is like Gigo, garbage in, garbage out to an extent. Like I mentioned, but however, I haven't said that earlier, right? The entity will give an undertaking that those information are actually true. To ensure that there's a good understanding of credit rating, the outcome are communicated in simple alphabet. One will take us through those ones later on in the presentation. Now, talking about Agusto's approach to credit rating, what we adopt is what we call the top-down approach or the macro to micro approach. So meaning that before we even assign rating in any country or in any economy, the first thing we try to do is to understand the operating environment. Given that we all know that there is no entity that can continuously outperform the operating environment. So we first try and understand the macroeconomic environment. What are the things that happen in the economy? What are the dynamics of the economy? What are the opportunities and threats in that particular economy? After understanding the macroeconomic environment, we now try and even understand the industry. Like Wonu mentioned earlier, one of the areas in which we have a niche is in research, right? And what we've done is that periodically, yearly, we actually issue sectorial reports on the various sectors on the economy, right? And that is meant to even drive the knowledge that will support the credit rating. In Nigeria, where we started out, we've covered over 50 industries. In Kenya, last year, we released the Ghanaian banking industry report. Even in Kenya also, we have we've covered about 5 industry over there also. So the essence is to understand the various industry, right? To understand the dynamics of those industry before even looking at entity. So thereafter, we do the company analysis, we score, and then we have the rating committee, which look at the proposed rating for that particular entity. Now, let's just have a quick overview on our rating methodology, and we'll look at the various institutions that we kind of cover. I think the first one we will talk about is financial institutions. And let's just look at the various factors that we look at when we are analyzing a financial institution. Of course, based on the financial institution, there are some factors that are more prominent and there are some that we downplay some other factors. So the first one we look at is capitalization, right? And here we focus on the adequacy of the capital of the business, of the financial institution, vis-a-vis the risk that they are undertaking. And also we look at it vis-a-vis the capitalization rule in that particular market. We also look at asset quality, right? Given that the main source of income for that particular financial institution will come from the asset base, right? Of course, for institutions like insurance companies, we downplay asset quality. Profitability is also another important factor that we look at when we're analyzing a financial institution, given the potential of capital to be a way of generating capital, of profitability to be a way of generating capital internally. And definitely, we also know that the return to the shareholders come from the profitability of the business. And in looking at profitability, our focus is on the consistency of that particular profitability of the company. We look at the liquidity because that one is also very important, and also look at the liability generation strategy. Of course, we look at staff productivity and also market share. Other things that we focus on includes the ownership structure, the support of shareholders, the efficiency, the efficacy of the risk management framework, right? Compliance, right? The quality of the management and staff, and also we look at the environmental and social impacts. For manufacturing companies and trading companies, we also look at profitability. Of course, we look at the operating cash flow, which is the primary resource that is used by the entity to meet its obligation as a full due. We look at how liquid, the liquidity of that particular company. We look at the financing structure and also the adequacy of working capital, because we all know that the working capital is what we actually use, the company we use to be able to continue its operation, and also the level of leverage. Things like in the risk profile of the industry, the market share of that particular entity are also under consideration. And of course, corporate governance, the stability of the management, right, and also the quality and timeliness of the financial report are also under consideration. For our investment manager ratings, the primary focus of our analysis are people, processes, and system. These are the primary things that we consider for investment manager rating. In addition to that, we also look at things like the organizational structure, the level of corporate governance, the quality of research, because this is actually a major backbone, because the quality of the research is what we feed into the investment management process. Trade execution, of course, risk management, and also decision-making within that particular institution. I think I will hand over back to Wonu to take us through the benefit of credit rating and also the studies of using Nigeria and Kenya as an example.
All right, thank you very much, Ayakunle, and good morning, everyone. So I'll continue from where he stopped and just move very quickly to talk about the benefits of credit ratings. So what do companies stand to benefit from getting themselves rated. So the first thing is that ratings provide an independent opinion of your financial strength. So it's one thing to be able to communicate how good your performance is, but it's a different kettle of fish entirely when an independent and reputable organization then provides you with an opinion of your financial strength. Where this outcome is really positive, it's a way to demonstrate strength and communicate that effectively to potential investors. Ratings also help to highlight the strengths and weaknesses of an organization. So it's a way pretty much to get free consulting advice. So while we don't provide rating advisory, the rating report highlighting the strengths, weaknesses, areas where improvement can occur can be very vital to helping that business to, strategize and shape its future. Then, of course, it can be a basis for comparison amongst peers. So you see where you are relative to your peers, because our rating outcomes pretty much measure the financial strength relative to other borrowers in the economy. Then, of course, like I said, it's a way of providing cheap consulting and obtaining cheap consulting advice, because from the rating report, you're able to see areas where you think you continue to allocate resources, areas where you think you need to improve, and things, you can get better at. And of course, it helps in the debt capital market in terms of the pricing of risk and sourcing for funding. I'll speak more to this in subsequent slides. It's also important to touch on the impact of ratings on, the broader economy or the economic stability of a nation. So when you think about it, ratings encourage governance. And I'm going to use Nigeria as an example. When you start rating entities and then their comments, because looking through what Ayokunle presented, each methodology had a focus on governance, which means governance is a key rating driver. And the more you educate the entities that are being rated on the need to have well-structured governance structures in place, the more that becomes a habit and the greater compliance to good corporate governance practices that you then get to see. And if, as a nation, most of our corporations tend to adopt good corporate governance practices, the impact should be positive overall. So you should find better governance structures, better oversight over our organizations. Then you think about it, access to foreign capital markets. I was speaking with Ayokunle shortly before this presentation, and I understand that more than 9 banks in Nigeria have actually issued Eurobonds successfully and have gained access to the foreign debt market, which is a positive. So because of the independent nature of credit ratings, and again, maybe speaking to the reputation of the issuers of those ratings, it has opened doors and led to access to foreign capital, which has enhanced the strength, which has further strengthened the financial position of these banks and the ability to do business on an even larger scale. Then, of course, it strengthens investor confidence when the bulk of the institutions are well rated. And it also gives the market credibility, because people then start to think, okay, this is a market that I can play in. This is a market that is regulated. This is a market where I can measure the risk that I am taking, and therefore I can price that risk correctly. And of course, bigger institutions definitely accelerate growth, because if you have bigger institutions, lots of the Nigerian banks now are no longer Nigerian banks, so to speak. Many of them now have branches, big offices in New York, in Europe, in Africa, and, are spreading. So big institutions can also accelerate growth for the companies, for their parent companies. So these are benefits as an economy that you portend to enjoy from having a ratings culture. So in terms of the output or the outcome of rating exercises, like Ayakunle said earlier, we run a simple alphabetical scale, which sort of helps in terms of understanding, and it's easy to identify when you see. So we run from the AAA to D, where AAA is issued or assigned to companies that we think have the best financial condition and strongest capacity to meet obligations as and when they fall due relative to all other issuers in the same country. So the idea is we're looking at each entity relative to all the other borrowers in that economy. So not necessarily hinging the rating on the financial strength of the government or the federal government. So we run that from AAA to D, where AA is a company with very good financial condition, A is a company with good financial condition, BBB is one with satisfactory financial condition and adequate capacity to meet its obligations. With BB, it also has satisfactory financial condition, but it has limited capacity to meet obligations as and when they fall due. Then we have B, which is weak. We have C, which is very weak. And D is for an obligor that is already in default. In addition to this simple alphabetical scale, we also have what we call rating modifiers, where we have the pluses or the minuses added to the alphabet. So you have a AA plus or a AA minus or an A plus or an A minus. So these modifiers, what do they mean? They pretty much just give the relative positioning of a company on a rating scale. So for instance, let's say companies that score between 70 to 79 are in the A category. You would agree with me that a company that scored 71 or 72 has a different financial strength relative to a company that scored, say, a 78 or a 79. And that difference needs to be communicated to the public as well. So you will find that companies that are in the 71, 72, 73 category will say are rated A minus. Those between 74 and 76 would then have the A, and those with 76 to 79 would then be A plus. So the modifiers just show the positioning of a company on a rating scale. So they are all A-rated companies, essentially, but there's one that is A minus, there's one that is A, and then there's one that is A plus. Okay, so that means a rating that is A plus is slightly higher than that with an A, and the one with A is slightly higher than the one with an native grade is for BB plus to D. When we look at investment grade, these are organizations that have good financial conditions. These are organizations that have relatively low risk of default, and they start from the BBB minus, which is the floor for investment grade. When we look at the speculative grade, this is non-investment grade. It means there's a higher likelihood of default, and these are companies that have, satisfactory to very weak financial conditions. Okay. So in addition to the alphabets and the rating outcomes, we also have rating outlooks, because, ratings are based on historical financial performance, meaning you're looking at audited financial information, which is dated and is sort of backwards. So we also have a forward-looking element to the ratings, which comes in the form of an outlook. So the outlook is pretty much saying what our expectation is in terms of that rating for the next 12 months. If it's a rating where we believe that there are positive market trends or favorable internal factors that can result in an upgrade in the future, we attach a positive outlook. For an institution where we think the elements, both internal and external, are stable, and therefore we do not expect any rating action, we say that rating is stable. But if it is a situation where there's potential market indicators, negative market indicators, that could result in a downgrade of that rating, we say there's a negative outlook, right? So in addition to the ratings, we also issue outlooks, which provide an insight into our expectation for the future of that company for the next 12 months. Okay, so I'm going to move away from ratings a little bit and to look at the debt capital market and to see what relationship exists between the between credit ratings and the debt market, and to what degree credit ratings can influence the acceleration or development of the debt capital market. So to do that, I'll start by talking about the debt market on its own. So when you talk about the debt market, if we strip out the debt there, we look at market. Market is a place for an exchange. So there are buyers and there are sellers. The difference here is we are selling debt instruments. Who are the buyers? Who are the sellers? The buyers are investors, pension funds, insurance companies, asset managers, retail investors like you and I as well. These are the buyers. And then we have the sellers, who are the issuers of debt securities. And these are governments,
from our side.
Hello, Wonu. We can't hear you.
a defined lifespan. This is one of the key features that make them fixed income. Had a bit of a technical challenge, so I'll just go over a couple of things again. So the first thing I said was that, it's a market, is where fixed income securities are traded. We have the buyers of the fixed income instruments and we have the sellers. When we talk about the buyers, we mean the institutions that invest or that buy. So we have the pension funds, we have the insurance companies, we have the asset management companies, and we have retail investors like you and I. And then when it comes to the issuers, it can be government, it can be corporations, and in some jurisdictions, it can also be municipals or state governments. Fixed income instruments, by their nature, they have a validity of a defined period. It could be, when we talk about debt, it could be money market, where it's short dated and has a validity of between 0 to 12 months. And that's where commercial papers come in, that typically have that validity of 9 months. And then anything above 12 months, we typically have bonds or notes. Okay, they're issued for a specified period. Is it 3 years? Is it 5 years? Is it, then of course, there's a cost. So there's some sort of reward that goes to the investors, which is the cost to the issuer, and that comes in the form of the interest or the yield. And of course, because it's a debt instrument, it means, unlike equities, the amount that has been borrowed has to be returned at maturity, right? So in the fixed income markets, we have different instruments. We have treasury bills, government bonds, commercial papers, corporate bonds. We have green bonds. We can have, many of different shapes and sizes. It can even get more interesting where we have, different structures, asset-backed. It can get a lot more complex, okay? So when we look at the relationship between ratings and the debt market, it's important to understand that ratings play a very important role here, because if an entity comes out and says, I want Okay, I'm sorry. I seem to be having internet connectivity issues. So I'll take the slide again. So I was saying that ratings play a very crucial role in the definition and the development of a debt capital market. Because if you think about it, if an institution comes out today to issue a financial instrument, at what price? What is that return that would be satisfactory? Okay, it seems that we're back now. I'm not sure what exactly is going on with the internet, but I hope we're back and for good this time. So it's important that investors are able to price that security. So at what price would I be compensated adequately for the risks that I am taking? Should I expect the same return, say, from an MTN versus Ghana Commercial Bank, for instance? What differentiates MTN from Nestle and differentiates Nestle from, say, Fido? How do I measure that risk and price it correctly? And that is where credit ratings come in, because then they give an independent and unbiased way for you to measure the risk and therefore to price the risk correctly. I'm looking at some active debt instruments, looking at the slide from the Nigerian debt capital market. And we have MTN, which is rated AA+. And you see that the rate that is applicable there is 12.75. And then we look at a Dangote at the time of A+, and the interest rate that was pretty much required from the investors was 13.5. And it's just to show that at the different rating buckets, the rates are different, because that's a way for investors to actually measure and price risks. So it helps to develop a yield curve. It helps to set investor expectations. It's an empirical way to determine the rates and yields and to hinge the pricing of the debt on the credit ratings. In general, where you have lower ratings, the expectation is that the higher the risk of default and the higher the interest rate that will be charged by the lender and vice versa. Okay, so where you have a very good credit rating, the expectation is that the interest will be smaller, versus when you have a higher credit rating and then the interest rate will be versus when you have a low rating and then the expectation from the investors will be higher. Okay, so again, still speaking about the debt capital market and credit ratings. When it comes to issuing debt instruments, the ratings are very critical. They also serve, in many cases, as an early warning signal to investors, to regulators, and to the market in general. When you see that the ratings start to decline, it starts to send a signal that there's something going on with this organization. It doesn't mean it's the end of the organization. It can also be a signal to investors or even bankers to understand, okay, is this a time to restructure? If the capacity to repay is either is diminishing, or in some cases it's being enhanced. So it can be a signal to the market to understand what is going on with that company and even perhaps the industry at large. So investors and regulators can then take proactive measures to mitigate risk before they fully crystallize. Investors generally view organizations with high credit ratings as less risky, and that naturally enhances their access to the debt markets, their capacity to borrow, and the rate at which they borrow. Okay, so I'll just look at, Nigeria and Kenya as, examples and see what those markets are doing relative to ours now. So, I mean, in Kenya, recently, there was an issuance, a debt issuance of, I think, 1.4 billion Kenyan shillings by the Kenya Mortgage Refinance Company. So it's a mortgage refinancing company that refinances mortgage loans, and then they go to the debt capital market to raise money and then to refinance. And because the outcome of that rating is positive, that's the sole reason that this sort of institution can exist. Because this sort of institution exists in Kenya, and we do have our version in Nigeria, because you're able to have an institution, of course, in many cases, backed by the government, able to access the debt capital market because of their good ratings and gets funding cheaply, and then use that to then refinance mortgage loans and make mortgages more affordable to the public. So the Kenyan Mortgage Finance Company was able to raise 1.4 billion. It was oversubscribed by 480%, despite the yields not being the greatest, but because of the perceived safety, again, which was measured by the outcome of the credit rating, the bond was rated AA-. so that's a positive example from the Kenyan market. At the end of the first quarter, I think the Kenyan market was at about $61 billion. When we look at the Nigerian market, in the Nigerian market, credit ratings have been very instrumental in developing the debt capital market. The debt capital market is, relative to most countries in Africa, very large, dynamic, has significant offerings, and has a lot of interesting offerings currently. At the end of the first quarter of 2025, the size of the market was about 66 billion. And you look at that relative to the Kenyan market and think, oh, it's not, it's not so much different. But the truth is, the size of the Nigerian market has also been impacted significantly in the last couple of years by the FX crisis that has been ongoing. So the size in USD has pretty much halved, and is truly not showing, the size, the developments and the additions and the growth that has happened in that market in the last 2 years. So, I mean, ratings have also impacted that market very positively. In Nigeria, for instance, PFAs, pension companies cannot touch an instrument if it's not rated. It must have at least 2 credit ratings for a pension fund to be able to invest. I know in Ghana, it's either it's listed or you have the rating route. And, potentially we're expecting that we're able to develop that ratings culture a bit more. Again, just showing some securities and their ratings, and again, emphasizing the role that credit ratings play in price discovery, in risk measurement and pricing. So we've listed some transactions. So you see here we have ABC Transports that was rated BBB minus and was borrowing at 16.5% versus Dangote's Industries, which was A+ and borrowing at 13.5%. So if you look through the list, you see that the higher the rating, the lower the cost of borrowing, right? So I'm just going to talk very quickly about the impact of rating actions, right? So, a question that we've heard from speaking to and engaging with a number of market participants has been, so what about rating actions? You've given me this rating today. There's no guarantee that that rating will be the same for the next 12 months, for the next, 2-3 years, or, so rating actions do happen. So when I talk about rating actions is where at the end of the review, at the end of the validity of the rating, we review the financial position of the organization again, and then we provide a rating. So the rating at that point can differ from what was initially issued. So for instance, a company that was rated A, upon an additional review, it's possible that the financial performance of that industry, that company has improved, and therefore that has necessitated a positive rating action where the rating now goes from an A, say, to an A+. It could also be the reverse, where an entity that was rated an A, upon secondary review, you're realizing that the financial condition has weakened, and therefore capacity to repay has also diminished, and then is going from an A to, say, an A-. What will be the impact of these rating actions? Of course, naturally, one of the most obvious impact will be on the pricing, because if the rating strengthens, then you're able to borrow cheaper. But if the rating weakens, then you would also have to borrow a bit more expensive. It could also mean the barrier to the debt capital market. It could open up that barrier or close it. So this is at the point where it straddles the investment to speculative grade. So if an entity that was prior to speculative now gets a positive rating action and becomes an investment grade rating entity, grade rated entity. So maybe you move from a BB to, say, a BBB-, then you are now able to access the debt capital market. Now, pension funds can then place money with you. So it has increased your access to funding. And of course, the reverse will be true for a rating action that brings an entity that was in the investment grade bucket to the speculative grade bucket. And of course, it would impact investor confidence. As the ratings are getting better, and as the company's financial position is getting strengthened and is reflected in the rating action, rating outcome, so the ratings are improving, then investor confidence continues to strengthen. And if it's the flip, then investor confidence also would start to weaken, okay? So I'm just going to talk very quickly about the lessons that, since being in Ghana since last year operationally, what are those things that we've learned by interacting with the debt capital market in Ghana? Transparency is a bit of an issue, so to speak, where because the ratings culture is not very rich at the moment, a lot of organizations are struggling with having to share their financial position with third parties or even with the public. So that's something that we've noted as an issue here. So a lot of companies are still a bit uneasy about being transparent with their financial positions. Then, of course, there's fee sensitivity. Okay, so what would it cost to get a rating done? And see, does it make sense for me to get a rating done? But the good thing is, I mean, with the current government, where we've seen yields drop significantly, I think the positives or the benefits of getting a rating and accessing the debt capital market have become increasingly obvious. Then, of course, governance again, from my experience here, seems to be something that a lot of organizations might struggle with a little bit, where we have, because a rating required, governance is a key rating criteria, and a lot of organizations are struggling, so far. Many organizations we've interacted with are struggling with putting together that sort of strong benchmarks for governance, and, that's a key rating determinant. And then, of course, there's the novelty of ratings, meaning that ratings are new, and generally people tend to be a bit skeptical of things that are new. And it's one of the reasons that we're holding this webinar. We held one in the past. We've held two in the past. We held a physical seminar and a webinar, and we want this to be interactive. We want the opportunity to be able to talk to market participants, to be able to hear your concerns, and to be able to together work to find a middle point that would work for both, for all parties. So, I mean, it's one of the key reasons that we're having this webinar, and we'll continue to have many of such. More so, we're available. We're here physically, and, where you can reach us, WhatsApp, phone calls, emails, and just to, make ratings a more familiar factor in the debt capital market. Okay, so I'll just end by saying that, ratings in Ghana, like in other African markets where, a ratings culture has been developed, will be very critical to creating new growth spots, driving infrastructure developments, and driving foreign capital, and will be a very positive addition to the market. So I think I'll pause here, and so we can start the 3 minutes beyond time for the Q&A. So I think I'll pause here, and I'll hand off.
All right. Thank you, Wonu and Ayokunle, for your insightful presentation. So as you mentioned, we will now open the floor for questions. So I'll hand over to Prince to moderate this session. Thank you.
Right. Good morning, and thank you, Wonu and Ayokunle, for that insightful presentation and for explaining to us in very simple terms. Let me put my video on, please. Yes, and for explaining to us in very simple terms the impacts and the importance of credit rating, especially for our DCM space here in Ghana. So just some small spin points before we start the Q&A session. Please, you can drop your questions in the Q&A chat box that is below the presentation slides, and then it will be attended to, or you can alternatively use the raise hand emoji that is also below the presentation slide. So to start your questions, please, we would like that you add your name and then possibly your organization. So with that, we can start the questions now. I think I can see the first question over there, and then we continue. Right, so we have a question from Patrick Obing. Actually, these are two questions. So the first question is,
Does Agusto and Co. and research reports, does Agusto and Co. do research report on the industry sector in Ghana, especially the mining? So you're asking about whether Agusto and Co. does sector reports on mining. This sector contributed 8.9% of our GDP, and I believe most investors will be looking at that area. All right. And then the second question is, are there any success stories on or research examples in Ghana where ratings significantly influenced investment decisions? Very well. So I think this question is on the mining sector. Christian, would you like to take this question, please? Hello. Hello, please. Christian, would you like to take this question, please?
Hi, Prince. I think his mic is unmuted, but he's trying to speak, but we can't hear him.
Oh,
Okay.
okay. Prince, can you hear me now?
Yes, I can hear you, Ayokunle.
Okay. So while Christian is trying to sort out his connection, I think I will take the first question while Wonu we take the second question. Like I mentioned, we just entered the Ghanaian market last year officially, and then we're starting out with the banking industry, right? And thank you, Patrick. I think the mining sector is also one of the sectors that we are considering to include in our coverage in Ghana. So I'm sure before the end of the year, we're going to introduce more industry, and I'm sure that mining is also one of the industries that will actually even include within our coverage. Having said that, it doesn't mean that we don't even analyze it internally. So we analyze it internally. We actually have our own view on those industries, but in terms of producing is a comprehensive codified report that will be shared with the public, right? So definitely we should have more reports out before the end of the year. So Wonu, can you take the second question about the investment?
Success stories, yes.
All right, thank you very much, Patrick, for the question and about success stories and recent examples in Ghana. I think very recently, I think Fedco, there was a CP issuance recently, and I think it's testifies to a success story in Ghana. So I think that was listed as well on the Ghana fixed income market. Maybe Umar will want to speak to that. That was a positive development and is the first CP that has been issued. So I think that's a positive development. We're hoping for more.
Right. Thank you, Wonu. To the next question, we have this question from David. The question is, how does Agusto manage the possibility of risk inflation due to issue pay model? And then also, if there are some significant challenges in credit risk that we consider when doing a ratings migration. I think, Ayokunle, you'd like to take this one.
Thank you, David, for the question. And if I understand the first side of your question, you're talking about how we are managing our operations, right? I just hope I get your question correctly. How we're managing our operations given the high inflationary environment that we have in Ghana, right? If I understand your question well, right? And normally the ratings are actually for 18 months after the date of the financial statement used for that exercise, right? That's the validity of that particular rating. So what you typically see is that the ratings are renewed annually. Okay. While for that of instruments, right, what you see is that the ratings are actually renewed annually. So what you see is that the fee that you've paid for a particular year, next year, by when you are doing the renewal, of course, the inflation in the environment, and also what is happening in the inflation environment will be factored in determining the fee for that particular exercise. Okay, your second half of the question, you're saying that what are some significant changes in credit risk that you consider when doing a rating migration? Okay, earlier in the presentation, we've actually even gone through the rating methodology. So what you've seen during that particular area is that when you are doing the review, there could be an area in which the risk profile has actually increased. So what do I mean? For instance, right, you could see a company that maybe within a year, let's assume you're looking at a financial institution, probably the asset quality has deteriorated, right? So definitely that will also affect the rating migration, right? Or it could be that the capitalization has actually even dipped. It could be that the liquidity has actually even deteriorated. And it could be the other way around. It could be positive. For instance, the organization has even raised capital such that they're actually even stronger now. So that will also be that will actually even put into consideration in our review. Thank you.
Thank you, Ayokunle. Sepas Mpong, could you please unmute your mic? I saw your hand being raised, and ask your question, please. Sepas, we are still waiting for you, please. All right, I think we are having some challenge with this. But let's go to Papa Sam Blankton. Your hand is raised. Please unmute and ask your question.
Hello, good morning. Yes, so my question is, please, can I be heard?
Yes, loud and
great.
clear.
So my question is a question on incentives, right? So aside the argument of reputation, how do rating agencies in general keep the incentive to rate unbiasedly, especially because the institution they are rating is the institution that's paying for the rating. And so that is essentially my question. Thank you.
Right, thank you. I think this is a very interesting one. Wonu, I think you'd like to take this.
All right, thank you very much for your question, Papa. And this is a question that we get quite often. So yes, it's the institutions that pay us. But one of the things that because reputation is pretty much what we sell, and independence is the market that we sell. So the key thing is to ensure that there's no threat to our independence and there's no perceived threat to our independence. So we have structures in place to ensure that. So the first thing that we do is that we take care of the commercial side of things before we commence a rating activity. So the commercial sides are done and handled by a different team than the team of analysts that actually then do the work. Then, in addition to first of all, separating the commercial from the technical side of things, we also have internal mechanisms. So a rating outcome, it cannot be determined by one person. It's determined by a group of people. So first, there's the team lead who reviews. From the team lead, the group managing director of Agusto who reviews all ratings. Once that is done, then we have a rating committee of 4 to 5, depending on the industry, 4 to 5 professionals sat across different parts of the world and not in the same place at the same time, who independently provide their opinions on the rating. You have to have a majority. So it'll be very difficult to influence every stage of that outcome in determining a rating outcome. So internally,
I think we lost Wonu over there whilst she deals with some of these technical challenges.
okay,
Wonu,
so
are you
I think I'm back.
Right. Okay.
So I was saying that in addition to our understanding that independence is what we sell and our own need to ensure that we preserve that, there are structures within the organization and how rating practices are conducted that prevent that from happening, right? So we have structures internally, and beyond that, as a final layer, we are also regulated. not just in Nigeria. We're regulated in Nigeria by the Securities and Exchange Commission, in Ghana by the Securities and Exchange Commission, in Kenya and in Rwanda by all these Capital Market Authority of Kenya, the Securities Exchange Commission in Rwanda, by all these different, so, you know, those provide further incentives to just remain on the straight path. So I hope that answers your question.
Right. Thank you, Wonu. I think Cephas mentioned his question in the chat box, and this is what we have. What are the factors considered in credit rating assessment?
Okay.
Wonu, I think you would like to take this as well.
So perhaps Cephas missed some parts of the presentation because I think we went through that, but it's not a problem. I can send you our rating methodology, which has the methodology for all the different entities. So you can just send me an email, but I'll just answer it very quickly on the call as well. So we have different methodologies for financial institutions and non-financial institutions. For financial institutions, we look at capital adequacy, asset quality, earnings, liquidity, and quality of management. And of course, we have a list of qualitative factors. For non-financial institutions, we look at profitability, we look at working capital, we look at cash flow, we look at leverage. So those are the things that we look at. But I would again respond to this in the chat box with my email address. If you send me an email, I can send you a document that actually does have all the documents, all the methodologies. So I mean, at your own time, you can also take a leisurely look at it.
Right. Papa Blankson, before I come back to you, we have another question from Patrick Obing. The question is, what is the role that ratings play in supporting SMEs looking to raise capital in the debt market? Christian, you'd like to take this, please? I think your mic is muted. We can't really hear you.
Can you hear me?
Yes. You are up now.
Okay, so if I heard you correctly, you want to know the role rating, credit rating plays for SMEs seeking to raise funds from the debt capital market, right?
Exactly.
Okay, so yes, like we had mentioned during the presentation, rating is actually an independent and internationally recognized way of getting the financial strength of any entity to investors. So for SMEs looking to raise money, I mean, there is no better way to do that other than having being an independent opinion from a credit rating agency like an Agusto and Co. However, ratings thrive on availability of information. So SMEs will need, to a large extent, into some of the things we had discussed around putting together their governance structure, also enhancing their financial reporting that will enable us have access to credible data, financial data on their various operations, so that we're able to give a credible opinion. So yes, credit rating has plays a very significant role for SMEs, but it needs to be two ways. The SMEs also will need to play their role, their part in enhancing that as well. Thank you.
Right. Thank you, Christian, for that insightful answer. Back to Papa, please. You can ask your question now. Hello, Papa Blankson. Ask your question now.
Yes. Okay. Hi. Good morning again. So I have two quick questions. One is I just want to know, in terms of best practice, right? When a rating agency rates a bond issuance, like a particular issuance, or a issuer who is on the market, best practice is an initial rating before the bond is issued, the end, or the credit rating will usually sort of employed to rate them probably every year within the program, so that as their ratings get better or lower, investors sort of have a certain sense of it. Or it's just the rating is just done at the beginning, and then that is it till the bond issuance is over and the issuer is coming to raise another bond. That is if the issuer is going to pay for the rating. That's the first question. If that is what is happening across the markets. And then my second question would be like sort of like a comment, right? When one of the speakers was sort of explaining the ratings and the whole concept, he spoke about the fact that in terms of the rates, the agency, they get their information from the customer. Of course, the customer undertakes that the information they give is true, and that they don't do as much detail as probably the auditors will. Do the rating agencies sort of contact the auditors? Because I'm assuming because the auditors will do probably some more in-depth analysis or in-depth due diligence. Do they contact the auditors to sort of confirm the veracity of the information that has been given to them by the issuer? Thank you.
Right. Thank you, Papa, for your answers. Wonu, would you like to take this one?
No, great. So I will take the question.
Right.
Can you hear me?
Yes.
Okay. Fantastic. So thank you very much for the question. So to respond to your first question on the issue rating, so we typically have an initial rating for an instrument, which is valid for the life of the instrument. However, that rating is subject to annual renewal. So the rating will need to be renewed on the anniversary of the issue to validate the performance of the issuer with respect to meeting.
We can't hear you.
So can you hear me now?
Yes, I can hear you loud and clear.
Yes, we can hear you.
Okay, so I don't know where you lost me, but maybe I'll take it all over again. So I was saying that the rating is an initial rating that is valid for the life of the instrument, but that rating will be subject to annual renewal. So we do annual renewal on the anniversary of the issuance of that instrument to validate the issuer's capacity in meeting the obligation on a continuous basis. So it's not a static rating. If that's what you meant by the first initial rating. So it's not static. That issue rating will be renewed on the anniversary of the bond. To your second question on to what extent we due diligence we do with respect to audited accounts that are provided to us. Again, it's important to re-emphasize that as far as rating is concerned, it's not an audit exercise or a forensic investigation. So we're not auditors, we're not forensic examiners. We place reliance on the audit output that has been provided to us. However, if during the course of our review, there is a need to maybe clarify one or two information in the audited account that was provided, we'll not hesitate to reach out to the auditors. There has been cases where we needed to speak to the auditor to clarify one or two things in the audited account. We typically do that, but with written consent of the client, of course. So if we need to clarify gray areas in the audited account during the course of our review, we'll reach out to the client to grant us that permission to speak to the auditors and be able to clarify that. So we don't just take what is thrown at us, hook, line, and sinker, the point I'm trying to make. So we also do own due diligence and clarifications where need be. But we won't go in and start asking for source documents to start re-auditing the books of the entity we rate. Thank you. I hope that provides clarity.
Right. Thank you. Thank you, Christian. And then I see a question on someone asking for the recording and then the slides after the session. Yes, the recording and the slides will be shared after the session. I think we are almost done. Our time is up. It's past the hour mark. We will take the last question and then wrap up with this. I saw a hand up, Vicentia. You could please ask your question. This will be the last question for the session.
Hi, thank you. A follow-up to the answer given now about the bonds. I want to find out whose responsibility would it be to disclose the subsequent ratings that will be done for the bond. I mean, just a follow-up to the question Papa Sam asked.
Right, thank you. Christian, you'd like to take this, or Ayokunle?
Okay, thank you for that information. Let me first even add one or two things to I think the question that Papa asked that the Christian was actually even answering. Initially, in the letter of engagement, the client typically give us the consent for us to disclose to have discussion with their auditors if need be. At times, even as part of the engagement letter, they also give us the right to even contact the regulator if they are operating in a regulated environment. For instance, it's a bank or an insurance company that is operating within a regulatory framework for us to even contract the regulator. That's fine. Then I'm coming back to the last question. Normally what you see is that for bonds that are listed, normally the exchange will actually even ensure that, look, what you have on their website, right, that you submit the current rating of that particular bond. So meaning that before the anniversary of that particular exercise, you see that the exchange will be prompting the client, right? The client and even the trustees to supply the updated rating. Having said that, on our website, all our ratings are disclosed there, right? So whenever there is actually a review of the rating, the new rating will be uploaded on the website, stating clearly the issue date, the expiry date. In the case of a bond, when next we are going to review that particular rating, everything will be stated on our website also. Thank you.
Right, thank you, Ayokunle. And I think, Vicentia, that answers your question. This will bring us to the end of the Q&A session. And thank you all for your active participation and your questions. And I hope that the answers that were given were insightful enough and that we have all been satisfactorily answered. Thank you. And I think I will give it back now to Umar. Umar, please,
right.
over to you.
Thank you. All right, sure. Thank you, Prince.
Okay.
And thank you to Agusto and the entire team from Agusto for sharing your expertise and for an insightful
Oh,
presentation. And also thank you to our audience. As usual, we had a very healthy participation. Thank you for making this event a successful one. I think after the program, we'll make the slides, the presentation available, and you can feel free to reach out to Kifim or to our colleagues at Agusto and Company if you have further questions. And so thank you once again for joining us. Until we see you on the next call, enjoy the rest of your day and take care. Bye-bye.